Hello, everyone. We are super excited to have you with us today. We have Ute Heidenreich. Did I say that right, Ute?
That's perfectly great. Thank you.
She has over 25 experience with doing 1031 exchanges, and this is such an important topic for you guys to understand. What is a 1031 tax exchange? If you ever work with an investor, you need to understand this. This is absolutely imperative. We're going to be diving really deep into this. So Ute, welcome. Let's start right in. We don't have a lot of time, so we want to know, first of all, what is a 1031 exchange?
Absolutely. I appreciate being here. Thank you so much. And I look forward to answering questions. And I think Chantel will have my contact information if you have something coming up later. A 1031 exchange is a great investment vehicle, a great vehicle to save and defer your capital gains taxes and your depreciation recapture taxes when you're selling investment real estate and purchasing other investment real estate. It's rule intensive and it has, a lot of deadlines and things of that nature. The regulations are in place from the IRS that require you to use a qualified intermediary, which is what my company does. We serve in that capacity, which means we document your exchange so that you have all the pieces of paper in the event the IRS comes to audit you. And we hold the funds beyond the taxpayer's control between the closing of the sale of what we refer to as the relinquished property when you're selling a piece of investment real estate and the purchase of replacement property. So those are, I know there's a lot going on there, and we will go into details and into examples. But a 1031 is a vehicle to defer your capital gains taxes and your depreciation recapture taxes when you're selling and purchasing investment real estate.
Okay, so we're going to call it property A and property B. So let's pretend that I have a commercial property on property A. And now I go, I don't want this commercial property on property A anymore. I want to buy another commercial property on property B. So I want you to tell me how many days I have to nominate that potential replacement property and how many days do I have to close on it and all the different rules that go with that.
Okay. So the most important thing is that you will, when you're selling real estate, when you're selling property A, you will need to put in place the exchange documentation. And to that end, a qualified intermediary will look for a copy of the sales contract, and they'll want to know who's handling the closing so that they can send instructions. The important thing is that the taxpayer never get even constructive control of the funds. So on the closing statement, we will look for a line item of exchange proceeds to the qualified intermediary so that the taxpayer doesn't get the money on the bottom line. The closing date on the relinquished property A, will set your clocks running, and you will have 45 days to identify and up to 180 days to close on replacement property. There's a lot of rules involved in the identification, and it's important to note that those deadlines are firm and they are only ever extended when either where your business is located or where where the property is located is in a county that is declared a federal disaster area. Like after the wildfires, I have a customer right now who is getting an extension until October 16th because the property that she is planning on buying is in LA County, which is subject to a federally declared disaster. But we don't want to rely on that. We don't want to have hurricanes and we don't want to have those kind of things. But you will have 45 days to identify, up to 180 days to close. The identification rules are a 3-pronged set of rules. Most people use the first rule, and that's the only one that works for people who are planning on buying just one replacement property B of equal or greater value to the property that they sold in order to obtain that full tax deferral. That is called the 3-property rule. And what it says is you can identify up to 3 potential replacement properties without having to list a value next to them. The idea behind it is that you've picked one, you've picked property B, but you do get to give yourself a backup or two. Some people use 1031s to diversify out of big property A into a number of properties B, C, and D, and on. For people who are using 1031s to diversify, there's a second rule, and it's called the 200% rule. It does involve math, which is why it's not my favorite. But it says that if you want to identify more than 3 potential replacement properties, then you have to list a fair market value next to each of the properties that you're identifying. And the aggregate fair market value, adding the 4, 5, or 6 of them together, can't be more than 200% of the value of the property that you sold. So basically,
give you an example of that, because I think I understand it, but I just want to make sure.
Sure.
So I have a property, let's say that's $1 million. Okay. Mm-hmm. And I want to, I can either say, okay, $1 million, I can pick these 3 properties. It doesn't matter what the value is. That's option A. The second option is I can identify more than 3 properties, mm-hmm. but if I want to, let's say I wanted to name 10 properties over here, the total, but the property I'm selling is $1 million.
Right.
Then I could name 10 other properties over on this side, as long as the total value of those 10 properties didn't exceed
$2 million.
$2 million.
Yes, 200% of the million. So
$2 million, all 10 of those properties
added together
have a value of more than $2 million.
Right. And the idea behind, I used to call it, you can't attach the 757 multi-listings and say, I'll buy a few of those, right? The rules require you to be more specific. And one thing that I add when people say, well, what's the fair market value? Is it the asking price? Is it the assessment? What is it? Our suggestion would be that you use the amount of money that you are willing to pay for the property. And the reason for that is the third rule, which is very difficult. And I used to call it impossible, but there's one person who proved me wrong. So it's not quite impossible, but it's very hard. So the third rule is called the 95% rule. And it says, if you go over 3 properties and you go over 200%, then you have to close on 95% of the value of the property that you identified for the exchange to be valid at all. So most people will use that 200% rule. And in your example, they'll identify 10 properties, but they really only expect to buy 5 of them to get back up to that $1 million value, right? But they have their backups and they have the opportunity to juggle around. And well, if this one doesn't work, then I can buy this one. But the third rule, that's why we say use the amount you'd be willing to pay for a property as the value, so you don't accidentally jump over into that 95% rule. The person who proved me wrong sold a piece of land, a large tract of land, to a developer for $400,000, and they identified 9 townhouses, I feel like, and they went over the $800,000. It was like $1 million in total for the 9 townhouses that they identified at the time. It's been a while. And I was worried the whole entire time because I thought, oh, if one of these falls through, if one seller backs out, if one of them has a title problem, he's not going to be able to, he's going to be in the 95% rule and he's not going to qualify for his whole entire exchange will blow up. And he said, it'll be fine. And it was. So it's just one of those things. But
so let's pretend someone has a commercial property and now they say, I'm tired of owning commercial property. Commercial property is kind of going a little bit down in value. Some would say, some say it's not.
Right.
Let's say they say, I want to move to going into residential homes.
Yep.
What is that? How does that look? And then also, does a vacation home qualify for a 1031 exchange?
Those are absolutely great questions. So the great thing about 1031 is that all real estate, as long as it's held for investment, is deemed to be like kind to other real estate. So you can sell commercial properties on this side and purchase residential property on this side. So long as especially the residential property is going to be held for investment and is going to be if it's a house, obviously you would want to have rental income from it. So a vacation home is a very, well, let me back up. So there was a case in about 2014, I think, where somebody did an exchange and they exchanged their purely second home, or they tried to exchange their purely second home. Had never rented it out. They were, just dealing it with it, spending time there themselves on the weekends and on vacation, for another one, a better one, a more expensive one. And they filed the Form 8824 to report their exchange, and the IRS challenged their exchange, and it went all the way through the courts. And the argument the taxpayer made was, well, I bought this property that I sold in the 1031 with the intent that it appreciate in value, and that should be sufficient investment intent. And the court unfortunately didn't agree with that. And so that set, especially the resort communities like Sandbridge, the Outer Banks, the ski vacation places, that set them all on edge at the time. And so the IRS came out with a safe harbor that allows you to, if you have enough time, if you have a purely second home and you change it into a investment property, you use it only 14 days or 10% of the time that it's rented, and you have rental income, and you do that for 2 years, and then you do an exchange, and then you do that with the new property for another 2 years, then the IRS has said that they are not going to look what you used to do, and they're not going to look at what you're doing down the road. But it is obviously a lengthy process that you'd have to engage in when you're trying to sell something that was purely a second home. So a second home does not qualify.
So let me understand what you're saying. So you're saying the vacation home qualifies as long as you have a vacation home, but you have to rent it out to somebody else for more than 90 for a certain amount of time.
You can't. So it's kind of backwards the way the IRS looks at it. You can't use it yourself for more than 14 days or 10% of the time it's rented. In order to qualify as an investment property. That does not mean that you can't go there to fix things and paint things and clean things. And I always say there's probably not an IRS agent at every cul-de-sac in the Outer Banks to look to make sure that you're not there more often. But obviously you will want to have, if it's an investment property, or a vacation home, you will want to have rental income and treat it as an investment property on your tax return.
So as long as you don't stay there for more than 14 days or 10% of the number of days that it's
rented out. Right. So, in these resort markets in the summer, obviously they will be rented maybe from May to September. And in the winter places like Wintergreen or places like that, it'll be the opposite. So it doesn't have to be a rental that is continuous. It could be that one of those weekly rentals, right?
So let's say I have one property. I want to talk about the possibility to exchange out one property into multiple properties. So let's say someone has a property of $1.5 million currently. They've already done an exchange into that one. So let's say that's 1.5, but now they want to turn that one property into 5 properties. How does that work?
Same. Again, 1031 is a tax deferral. So when they originally did their exchange from the one property into the one what's now worth $1.5 million, they deferred some gain on the property that they originally sold. So that's deferred. And then presumably it went from whatever they purchased it for, maybe $1 million at the time, to $1.5 million. So that's great investment results, right? And then they do their exchange. And they can identify more than, they can identify up to $3 million, 200% of the 1.5 million in properties. And then as long as they're purchasing $1.5 million worth of replacement property, whether that's 3 or 5 or however many, they will continue to defer the tax obligations from the original transaction and the tax obligations on the new gain. So again, they can use 1031 to diversify, and they can use it to go from one property to several. I also have customers who go from several properties into one bigger one. That's a little bit more complicated because each 1031 has its own deadlines. And so when you're trying to sell 2 or 3 properties to buy one bigger one, it's important to remember that your first 1031 closing, your first sale will set your clocks running, and you'll have 45 days from that date and up to 180 days from that date to make that all happen all together. So you have to be sure that you're going to be able to sell all 3 of them in that scenario before you have to close on the replacement property.
So one of the things I always say is that you're unemployed until your next sale. So when you're in real estate, you earn the money, you get paid, and then you're actually unemployed again, right? That's how real estate works. So we want to teach everybody how to conduct themselves as a business and not just be real estate agents, because business owners, being a business owner, will help you retire. And so I want you to look at something that is the next level, which is Robert Kiyosaki's cash flow quadrant. And so what he says is that the next level of a business owner is like, okay, ask yourself, am I on this side or am I on this side? Am I just self-employed, or am I a business owner, or do I take it to the next level and have passive income? And that's really what is great, is because we teach you, number one, how to operate on this side where you're a business owner and also are creating passive income. And what I say is, does your system, does your business work independently from you? Like, have you ever been to a real estate agent retirement party? Like, I never have, right? Like, I've seen people, that have been in real estate for a really long time. It ages you. But I know one thing, I don't want to be showing homes on Saturdays and Sundays, getting calls at night. And I don't want to, when I'm 65 years old, doing that. And so that's what we're trying to solve, is saying, why don't agents retire? Well, there's all kinds of reasons. There's no retirement contribution matched by their employer. Healthcare prices are going up. Prices in general are just insane right now. And even if you have a rental property that maybe makes $3,000 a month, you're spending $2,000 on expenses, and then you just aren't making enough passive income. So what we want to teach you how to do, we call it now and later. Like, the candy, now and later. Well, we want to have you have money now, and your now money is helping buyers and sellers buy their home and sell their home. Yes, let's do a little bit of that, but we're going to help you create that later money, which is where we can retire, or at least have some kind of retirement money addition to what we're already making. And so that is the real basis of our brokerage. You can build your own brand, you can be successful, and we give you all the tools and support to fast track your business to success. So can I take advantage of a 1031 exchange if I want to acquire a replacement property in a different state than the relinquished property is located? So let's say I own a property in Virginia, and now I say, okay, I want to now, Florida's popping, so I want to now buy a bunch of properties in Florida.
Absolutely.
How does that work?
That works just great. The great thing is that all property within the continental United States, as well as Alaska, Hawaii, and Guam, qualify, as well as the U.S. Virgin Islands. So you have some options. You can go anywhere within the country, or to Guam or the U.S. Virgin Islands. Puerto Rico has a separate tax rule, and so that Puerto Rican property doesn't qualify. And the nice lady who I did an exchange for a few years ago, who then said, oh, I bought this property as an exchange, but now I find this darling apartment on the railroad to Rome. That doesn't qualify. So you can't leave the country with the money. That's, but you can stay within the U.S., the Virgin Islands, and Guam.
So you're saying Puerto Rico, if I wanted to buy a house in Puerto Rico, that one does not work.
That does not qualify. And I'm not really sure what in the special tax treatment Puerto Rico has that causes that to not qualify for a 1031. I don't know.
And is it okay to buy the property that your business occupies as a tenant? Is there any rules on that?
Nope. That's perfectly fine.
So let's talk a little bit more about what the tax implications would be if you go from one to another. But let's say you can't find a property. So let's just use a very specific, let's say $1 million. Let's say $1 million is what you're selling. But now you go in and you go, I can only find 2 properties that I like for $500,000. How does the tax implications work for that?
So I am not a CPA, full disclosure. I am a lawyer, but what happens is when you're not trading equal or up in value, meaning the contract price, you are going to have a tax consequence. And whether a 1031 still makes sense for you is really going to depend on the specific situation. In your example, you sold something for $1 million, you find $500,000 worth of replacement property. So you're going to have taxable boot of $500,000, right? And then it really is going to depend on what your basis was, your adjusted cost basis in the property that you sold, in your $1 million property. Because if that was $100,000, then you're still getting, and I'll talk about what the adjusted cost basis is, but that's really very fact specific on each transaction. Let's say, you were really fortunate, your basis in your $1 million property is $100,000. You've had it forever. You've depreciated it and all of that. So your adjusted cost basis is $100,000, and you're selling for $1 million, finding $500,000. You're still going to benefit to the extent of $400,000, the difference between the 100 and the 500 that you're replacing.
I want you to simplify it a little bit, because I think I'm worried that you're going to lose people. So first, explain what is a taxable boot. You use that term.
I know, yeah.
You use the word basis. So before we because this is really important for people to understand, so they can have these kind of knowledgeable conversations with a savvy investor. So first of all, what is a taxable boot?
So anything that you get that is not like kind property, anything that you'd get that's not other investment real estate is deemed taxable boot. And it comes from pirate booty. Literally, it does. So that's where the word comes from. So that the most obvious, which we talked about early on, is cash boot. If you decide you're selling something for $1 million, you're going to buy something, even if you're buying something for $1 million, but you're taking out some cash, that would be taxable boot. Anything that you get that's not the replacement property. If you take out cash, or if you buy property that's worth less than the value, you will have taxable cash boot. The second kind of boot is mortgage relief boot, which is why I always say I'm not an accountant, because so if you're paying off a mortgage on the property that you're selling and you're not replacing that with a mortgage of equal or greater size and or additional cash or some combination thereof, then you're going to have mortgage relief boot, which would be taxable. So on your $1 million example, if you're selling that for $1 million, you're paying off $500,000 in debt, and you're buying a replacement property for $800,000, right? You're going to still have $300,000 or so in debt, that you're replacing, but you're going to have $200,000 worth of mortgage relief because you're not trading equal or up in value.
Well, one of the questions is like, I've heard it called swap till you drop is kind of one of the things that I've heard people say, like they just swap till they drop, right? They're like, oh, let's go to another property and now let's go to the next property. And sometimes,
and the dropping is the unfortunate part, meaning you're dying.
Well, basically, sometimes people have you ever seen it where it's better to take the tax bite, meaning than to rush into a bad deal? You know what I'm saying? Like, people are like, oh my gosh, I don't want to pay these taxes. I don't want to pay these taxes.
Yeah.
And then they're like, oh, I've got to find a property. And so they just buy this and buy this and buy this. And it really wasn't necessarily the best thing for them. They'd have been better off paying the taxes. Have you seen that happen?
I have, unfortunately. And it's one of those things, especially in a market like the market we're in right now, where sometimes people pay more for a property, than the asking price. I mean, that seems to have been happening, fairly regularly. You really want to make sure that your replacement property works economically for you, right? So you can't just think about, I call it, don't let the tax tail wag the dog, right? Yeah, you're thinking, well, I'll have to pay this in taxes. But if the only properties that you're going to be able to buy are ones where you're not going to be able to collect enough rent to make it all work, right? To make your debt service and to make money off of it, which is why you're in this business in the first place, then it may not make sense. And unfortunately, there are just some people who say, I don't care, I'm not going to pay these taxes. But there are also plenty of people whose tax advisors will help them out and say, hey, look, this is what your tax bite is going to be now. You can't seem to find anything that makes sense to replace it with. Pay those taxes now. I mean, they're not going to get any lower capital gains taxes for most. And again, it's one of those things, it's very individualized, but for most people, capital gains taxes are going to be about 20% for the federal government. And in Virginia, it's going to be another 5.75%. And so they're not likely to get any lower. I mean, they've been lower. They've also been a lot higher. So sometimes, again, you would want to probably have this, or any investor would probably want to have this conversation specifically with their own tax advisor to make sure that whatever they're planning on doing makes economic sense as well as tax sense.
Well, we are about out of time. The last thing I just want you to share is like kind of a really big nightmare. So like, if you were thinking about a nightmare that you can think of, that it's like kind of, these are kind of the top 3 or the top 2 things you've seen.
Well, I mean, I think the biggest issue right now is obviously finding replacement property that makes sense. So right now I have most customers come kind of with both contracts in hand, just because it's so hard to find replacement property that makes sense. Big disasters usually involve people who overlook part of the whole thing. Like they're gonna say, well, I want to just not replace the debt. And sometimes people don't tell you that. So one of the things that happens in my business is we get this identification form in, and we see there's 3 properties on there. We don't know what they're valued. And the other thing is we don't know who owns them, because it's just the address.
But as long as it's only 3, as long as you only identify 3, it doesn't matter what the value is.
Right, it doesn't. But it may be a rude awakening at the end if you're selling something for $1 million properties, $1 million, and you're intending to buy just one of those properties, and it's quote unquote only 500,000, and then you buy that, and then if your basis in the property that you sold was 500,000, then you're really not having any benefit from the 1031. I see a question pop up on inherited property. So that's where that drop until you swap thing comes in, or swap until you drop. When I was in law school in the first day of tax class, the professor said, and when you die, your heirs get a stepped up basis in the property, meaning that all that gain that they've accumulated is wiped out. And if they sell the property right away, they're not going to owe any taxes. The bad thing about it is that you have to die before that happens for the people who you leave the money behind or the property behind.
Hold on. I need you to say that again. Yeah. Okay, so let's pretend. I don't like to say pretend anyone dies. So we'll just say person A dies.
Right.
Good name.
Right.
Person
and he
A dies and
real estate.
Person B inherits it.
Mm-hmm.
So
if you literally inherit the property, you're the child or whatever, your new basis in that inherited property is going to be the value of the property on the day Mr. A passed away. And so if you sell it right away, it's not likely that it'll appreciate again, right, from that date. So when somebody passes away and they leave somebody else investment real estate, it's a good idea to somehow document somewhere along the way what the value was at that time, whether you get an actual appraisal or whether you get an agent like yourselves to, to give you something in writing that says, well, by comps, this is what it's worth. Just put that in the file, because if you hold on to the property and then, 10 years down the road, you decide to sell it, then you have to pay taxes, unless you do an exchange, on the gain from the value on the date that Mr. A died to the sales price at the time you sell it.
Got it.
Then that's where that swap until you.
Well, Ute, that was wonderful. Thank you so much. And tell listeners where they can find you and where they can get more information about you.
I appreciate that. So I'm the president of Town 1031 Exchange. We're a wholly owned subsidiary of Town Bank, which is a $17 billion regional community bank here in Virginia and in North Carolina. We do exchanges all over the country. If you go to www.townbank.com and look under real estate, look for 1031. My contact information is there. My number is 757-673-1586. And I would love to talk to all of you.
Thank you for listening. If you enjoyed this episode, please subscribe, leave a rating and a review so we can get this out to more agents. And tune in next week for another power-packed episode. This is the Millionaire Real Estate Podcast.